So now let's talk about the auditor's process. All right, first we have this slide that explains an integrated audit, right? Integrated audit means I'm doing an audit both of internal controls over financial reporting and of the financial statements. And we talked about this idea that each of the audits can inform one another, right? So I can be doing my tests of internal control, and depending on if my control risk is high, medium, or low, that tells me how much I need to do in terms of substantive procedures. Similarly, my substantive procedures can inform me about the status of my controls, right? So I might think my controls are all good, but if I do a substantive procedure and I find a material misstatement, that kind of tells me there must be something wrong controls-wise. So the information flow can go two ways. All right, these are my steps in the audit of ICFR. So up here, I'm planning, I'm identifying which controls to test using that top-down risk-based approach from AS5 that we talked about. And I'm also determining if controls are designed properly, right? So this part of test the design is up here. And all this stuff is part of understanding the control environment. And then here is where I'm going to do my test of the operating effectiveness of controls. And then I have to evaluate my control deficiencies to see if I think they're control deficiencies, significant deficiencies, or material weaknesses. Okay, so I have this step here which talks about evaluating or understanding the control environment. So this is kind of that top level stuff of making sure I understand things like tone at the top, what management is doing, what the board and audit committee are like. And then I need to make sure I understand the financial statement close process. If you don't know what FSCP is, it's basically, this is the process a company goes through to close their books. And companies go through this generally each month. And then they'll have they'll do like a soft close each month, and then they'll do a harder close each quarter, and then very hard close at year end. So this is when, for example, they'll get all their balance sheet accounts, all the estimate accounts, they'll perform the estimations. So if you think about it, something like allowance for doubtful accounts, right? They're not completing that estimate on a daily basis. They'll do that once a month at monthly close. Account like Goodwill, they'll only do that impairment test maybe once a quarter or once a year if the company is not on top of it. So that's the type of thing they do in financial statement close process. They'll turn over, at the very end of the year, they'll turn over those income statement accounts and put them in retained earnings, right? All those good things are in financial statement close process. And in the upper level review controls, things like management, taking a look at the financial statements and comparing budget to actual, all that type of stuff is in financial statement close process too. And that's usually considered somewhat of a compensating control because it can capture lots of lower level control errors. So let's say I can have low level control errors in AP and AR in individual accounts, and they cause AP or AR or cash to kind of be out of whack. So the idea is when I aggregate my financial statements and then I give them to members of management to do kind of their overall reviews and take a look at the financial statements, if there are material misstatements in there from all these little controls being out of whack, management would notice, hey, these amounts look off, something looks weird here, and then they could make people, investigate what's going on there, and they would wind up catching the errors that way. So that's why they're called a compensating control, because they essentially are controls that compensate for the failure of these other kind of smaller, lower level controls. And this is just talking about how we know which controls to test, which processes are significant for control testing, what our key controls are. And of course, we had said we take this top-down risk-based approach, right? And so the idea is we want to identify risks of misstatement so that we can make sure we have at least one key control addressing each misstatement risk. So obviously, my place to start is identifying all the misstatement risks. So that's what these relate to, all my material misstatement risks, I should say. So larger accounts will have more misstatement risks. Accounts more susceptible to misstatement, such as estimation accounts, will have more misstatement risks. High volume accounts will have more misstatement risk. So these are, and you'll notice sort of these things look a lot like the inherent risks we already talked about. And interestingly, if I go down here on this next slide where it continues to list out more risks I want to consider, and I get to the bottom, it says, oh, by the way, the risk factors the auditor considers for their ICFR audits are usually just the same risk factors they look at for the financial statement audits, right? And so they're going to be basically the same risk factors we talked about back in Chapter 4 when we talked through the risk assessment process for the financial statement audit. So that's why all these are looking rather familiar to you. And same thing for the sources of misstatement, right? I'm trying to figure out at which points in these accounts there are kind of the key points where misstatement could occur, because that's where I want to identify the controls that are preventing or detecting the misstatements. And those are those key controls that I want to test. Okay, at this point, when I have identified my controls using my top-down risk-based approach, now I want to test their design and operating effectiveness. All right, and so briefly to talk about design versus operating effectiveness. Design effectiveness is essentially based on how the control is written. So design effectiveness is generally more, is the way this control is written going to work in theory? I would kind of consider it like the blueprint of the control. Like, is it designed in a sound way? So if this control is operating as written, will everything be okay? So it's all about the theory of it. Operating effectiveness, on the other hand, is all about reality. So it's all about whether the control is working in real life. So this assumes the control is designed effectively or written effectively, and it's all about whether it's actually operating the way it's meant to or supposed to. So with my whole purchase control, where two people are supposed to authorize every purchase, is that actually happening? Are two people actually putting their signatures to every single purchase over $5,000? Or, is 50% of the time only one person signing off? Or is 100% of the time no people signing off, right? So what is actually happening in reality? What is the truth of the operation here? And in terms of operating effectiveness versus design effectiveness, for design effectiveness, you can evaluate that generally just through pretty passive approaches, right? Just through inquiry, asking how the control is supposed to work, or observing the control being performed once, right? I can kind of understand, oh, this is how it's supposed to work. So it's really, again, just theoretically, how should this work versus operation. If I want to test operating effectiveness, then I'm trying to test, is it really working in reality, in the real world? So now at this point, I am trying to take a sample of every time this control has operated throughout the year, and I want to randomly test that sample. And this is an example of how many times I might test different types of controls, different frequencies of controls. So a daily control, I might get the sample of every time it operates. This would be daily and multiple times a day. You would typically get the sample of every time it operated, take a random sampling of 25, and then see how many times out of that 25 it operates. For weekly, you would test 5 weeks, quarterly 2 quarters, monthly 2 months. And these are the guidelines for non-statistical sampling. When we go into Chapter 8, we're going to talk about statistical sampling because we're going to come up with some extremely different sample sizes than this. And non-routine controls are tested when they actually occur. So this would be like, hey, they acquired another company. Now I'm going to look at all those controls related to M&A that they say they have. So this could be something like, oh, we get an outside valuation specialist to perform the purchase price allocation, right? It can be whatever controls they claim they have in place. So obviously you can only test that control when it happens, which may only be once every 5 years or whatever. And the extent of your test of operating effectiveness could vary based on the importance of the control. And this kind of plays into this idea of key controls versus non-key controls, right? I'm spending more time testing my key controls. Also think about this idea of where misstatement risk is. So if a control relates to AR existence, I'll probably test it more than a control related to AR completeness, because my AR existence control is where my misstatement risk really lies, assuming it's a for-profit company, right? Because we said that there was the risk of overstatement is heightened in the asset accounts. And the nature of the control also plays into this. So manual controls are going to be tested much more heavily than automated controls. And remember, we talked about this in Chapter 6. We were saying, hey, if a IT system, if we conclude that it's not reliable, then we have to test all the outputs of the system, like as if they were manual controls too. And frequency of operation. So the more frequently it happens, usually the more we have to test it. We see that over here on this slide, right? The more frequent controls, we're testing them more. The less frequent controls, we get to test them less.